Well, good evening, everybody. Thank you very much for joining this evening. My name is Paul Angell. I'm Head of Investment Research here at AJ Bell, and it's great to have you on board for tonight's Fund Ideas for Your ISA webinar. Now for the investment disclaimer for you to read through. The highlight here is that we do not offer investment advice, and if you are unsure about the suitability of an investment, we recommend that you seek qualified independent financial advice. So, ideas for your ISA. There's a few things that I'd like to cover in the next 15 minutes. Firstly, the different investment options available for your ISA. Then look into some ideas for building a portfolio. Then some ideas on researching investments for that portfolio. And then finally, how can AJ Bell help you yourself? Worth saying right at the outset that with these sessions, we sometimes get comments that they've been too complex, and we sometimes get comments that they've been too straightforward. So obviously we have a very broad audience this evening, so we hope that there's something for everyone in the next hour or two, but apologies if you think it's missed the mark at all on either of those points. So firstly, options for your investment ISA then. Well, there's four types of investment funds that we've grouped here. Firstly, there's cash and money market funds. These are the lowest risk funds. They deliver a return which should be ahead of what you can receive in a bank account, as these are linked to money market instruments which trade closer to the Bank of England's base interest rate that we hear about so much within the financial press. These funds are for investors who maybe are not looking to be invested in the market for the time being. Maybe they think that the market is a bit expensive, or that they just can't take the risk right now as they have a large purchase such as a house or something coming up. So you've got your cash or money market funds. There's your first option for your ISA there. Secondly, government and corporate bond funds. These are essentially debt, collective debt funds, either to governments or companies, whereby they're taking out debt. Funds have collected all of that into one instrument which you can access, and these will pay out an income over time with some capital volatility, but the principle should be good through the years. Next up, equity funds, here for if you would like access within companies, getting access to their revenue streams and their dividend payments as well. So these are the highest growth funds traditionally, so for the higher risk investors. And then finally, alternative funds. I think that's a picture of a logistical warehouse or perhaps a commercial property, but here we're trying to capture the fact that there are vehicles available which don't invest either in debt or equity, and a slightly different payment type, and these are available as well. So building a portfolio then. Well, when we think about building a portfolio at AJ Bell, we really think about combining assets that work together to deliver an outcome for an acceptable level of risk, and that's really the key point, hence underlining there an acceptable level of risk. Everyone has a different risk profile. If you speak with a financial advisor, they will put you through a suitability assessment to try and work out that risk profile, and that's so key to investing, because all these different asset classes carry different levels of risk, and so it's really important that we map the right asset classes to the right individuals, and as you select your own investments, that you're able to select the right investments for your own risk tolerance. So a few things to think about as you're considering what your level of risk is. Well, firstly, what are you trying to achieve within your investments? Are you looking to grow your wealth meaningfully? Perhaps you're a younger investor who is saving for retirement in a long time hence. Are you trying to grow your investments over the long term as kind of as much as possible? Or maybe you're actually just looking for an income, and those bond options, or maybe equities that have higher dividends, would be a good home for you if you're really looking for an income off your capital value. Or maybe you're just really concerned about protecting your capital from the effects of inflation, and then there are strategies out there that deliver capital preservation as the key outcome. Another important thing to be thinking about is what is your time horizon, and that's linked to your risk profile very much. Can you bear to see your portfolio going up or down through time, or actually would you rather just seeing a very steady, slow and steady increase in your capital value? Can you bear to see that volatility on the up and downside? We have the chart there to remind you, or picture there to remind you that there is no reward without some risk, but also that risk and reward are often not commensurate depending on the time horizon. So the first decision then, as you're thinking about which investment to select, is whether to go active or passive. Tonight we're going to be looking at 5 actively invested strategies. Here, these are where a fund manager has chosen a strategy, a particular strategy to their investment philosophy and process that they think will outperform markets over the long term. They will not be invested in the whole of the market. They will have picked a few stocks, combine them on the view that these will outperform the market over the long term. They will therefore tend to almost always be more expensive than a passive offering, and they also then therefore have the risk of underperformance as well as the chance for outperformance too. The alternative option, of course, is passive investing, and these are funds that are designed to track the performance of an index. There is no element of human choice in the holdings. Investors simply follow where the market goes, and these are low cost typically as well. So if you'd like to select an active fund manager, the first thing to say on that is that fund selection really matters. Here I've listed 4 major asset classes and just highlighted the difference in returns that the best performing fund in each of these asset classes and the worst performing fund, what their performances are on the last 5 years to the 31st of December 2023. And you see that there's a huge variety in returns. So in the UK all companies sector, the best performing fund has delivered 82% return for investors, whereas the worst performing fund has actually lost 5.5%. In the US, it's actually even more stark, and while everything's been up, some funds have more than doubled your money, 156% up in 5 years, whereas the worst performing fund up just 30%. And it's a similar story for emerging markets and the sterling strategic bond sector as well. So factors to bear in mind then when assessing active managers. Well, firstly, we like to try and separate the skillful from the lucky. We find that in the short term, luck can overpower, can outweigh skill in terms of the performance of a fund. Perhaps the manager just happens to have picked the right stocks for the market environment, and therefore their returns look better than they might do over the longer term, when we would say that the luck really is outweighed by skill. So we tend to look for long track records for our managers, and that really helps us build confidence that they are high caliber within their investment approach. Another thing to be aware of when selecting an active manager is that managers typically will have periods of underperformance relatively frequently. Whenever their style is out of favor, they will underperform typically. So perhaps you have a manager who really likes growing earnings within their fund, but perhaps the market has not been interested in that particular investment factor and has actually been looking at a different investment factor, and so the manager has underperformed, and you as the investor will be tempted to see this underperformance and think sort of you'd wear the performance down that yellow line on the left hand side of the chart, and then you think, oh, this is not good enough, I need to get rid of this manager. But often that would be the worst time to get rid of the manager, as actually their investment style then comes into favor and they have a really strong period of performance, and maybe after that period of strength, you think, oh, actually, this manager does know what they're doing, and you get back invested right at the wrong time again as the style factor turns against the manager again. So you see the point here. As with any investment, you do not want to buy high and sell low, quite the opposite. So with some ideas then in terms of selecting active managers, you will no doubt be amazed by the amount of choice that there is out there for you to select from. And here I've just listed a few of the investment vehicles, not even the investment asset classes, but the investment vehicles that are available. You have the active funds and investment trusts in the top left corner that we'll be looking at this evening. You have the passive funds I've already mentioned. Top of that, you have smart beta funds, which we don't have time to go into this evening. You have direct equities and bonds, so just buying an individual company or individual debt instrument, and then you have ETFs as well, which again we've no time to go into today, but a huge array of potential investment vehicles to choose from. So in this next slide, I've listed how we at AJ Bell try to take on the task of choosing which are the fund managers to go for. So we have 5 Ps. It's a relatively common framework of understanding fund managers, and these are philosophy, process, people, performance, and price. So firstly, we think, what is the manager's philosophy? What is the market inefficiency that they believe exists? And then process, how are they attempting to invest to make the most, to exploit that inefficiency? People, who is it that's making the decisions here? Do they have a team supporting them? What's the level of experience at play? Performance, how has this manager or their team performed over the long term through different environments? How is their approach stacked up? And then finally, price, how does the fund on a cost basis compare to peers? And of course, we're looking for value rather than price here. So a few ideas then, sort of a checklist for your own consideration with active managers that I've listed here. Things to consider. What's the investment style at play? Is it a growth style of investing? I mentioned it earlier. They're looking for companies with growing revenue streams, growing earnings. Maybe it's a value play. They're looking for undervalued businesses that they believe are due to have a price inflection. Or maybe it's quality. They're looking for the best businesses that will be able to defend their margins and revenues through time. Maybe it's large companies, maybe it's small companies. What's the investment philosophy and process? Is it well articulated and understandable? Who's the manager? How long have they been a manager? Is there a key person risk? If a manager leaves, actually, are you going to have to reassess your investment, or is there the strength within the team to continue the performance profile of the fund unhindered? You need to consider the fund size. Is it too small, and actually maybe it's not getting the focus from the asset management group, or the costs are becoming a hindrance to the fund, or perhaps it's too big and actually it's operating in a market that's actually too small to accommodate really active positioning by the manager. And that links to the next point. Is the fund genuinely active? Avoid closet trackers, avoid those funds that are actually really just giving you the market return, but you're paying active fees for. And that again links to the bottom one. Is the fund expensive, or is it good value? So a few ideas, a checklist if you like. And the reason why we put this checklist together is that all the information is relatively easy to access, either within the AJ Bell website or within the asset managers' own websites. So some of you will have spotted that I didn't mention performance there, and that's because I wanted to take a little bit more time around performance, and really to highlight the dangers of looking at past performance. Here I've pulled the annual returns of Alex Wright's Fidelity Special Values Fund, which is a strategy that we'll be hearing more on later. And he may thank me or not for doing this, but But the point is, if you were just to look at the last 2 years of relative returns for this fund versus the UK market, you'd be thinking, no, it's dull. It's not quite able to outperform the market. In fact, I'd have been better off in a passive. And factually, of course, you're correct. On those 2 years, on that 2-year period, you would have been better off in a passive fund. But then as we stretch the time horizon out further back, we see, oh no, hang on, 2021, a huge amount of outperformance. 2019 outperformed again. 2018 didn't, or maybe that's the time we think, no, not a great fund. But 2017, a good year again. You see the point. We have to look as longer term as possible to assess the quality of our managers and to assess their track record. A line from Warren Buffett, the greatest living investor, most people would say. And he says this about past performance. He says, if past history was all that is needed to play the game of money, the richest people would be librarians. And he's right. But of course, we know that that's not the case. We need to be looking in the through the windscreen, not in the rearview mirror with our investments. And it's not all about past performance. Past performance is no guarantee or guide necessarily to future returns. So how can AJ Bell help you? Well, there's a diagram here which shows that we have the full investment universe available on our website for anyone to use. This is probably most pertinent for those people who are entirely comfortable doing their own investment research. For those who need a bit of extra help, we have condensed research lists through the favourite fund list and the IT select list, which all these strategies that we'll be hearing from tonight sit on. For those who need a bit more help beyond that, we have a smaller list of funds which we house in our starter portfolios, and there's also some starter portfolio construction available with those too. And then finally, we have AJ Bell funds where we take the researching of investments and the portfolio construction. We actively manage those portfolios on our investment behalf, on our investors' behalf there. So to summarize, have a plan that meets your objective and your attitude to risk. This is the key thing with investing. Don't be random. Be thought through in terms of what you're trying to achieve, what your time horizon to do that is, how much risk you can tolerate, and therefore what investment strategy you will be pursuing. Within your researching of investments, remember that good fund managers exist, but they are hard to find, and even the good fund managers will underperform. Don't be surprised or concerned if you have a bad year or two, as we saw with Alex Wright's fund earlier. Next point, only invest in an active manager when you believe that they can outperform. Otherwise, just use a passive solution. If you're not sure about active, go passive. Next up, don't rely solely on past performance. It is not the panacea. There's a lot more to consider out there. Finally, regularly review your portfolio to make sure it's on track, but do resist the urge to tinker. We see a lot of short-term trading on the platform rather than long-term investment. As we spend less time in the market, we are less likely to capture all the gains that are available over time. And that really ties into my final point there. Stay the course with your investment strategy as you try to meet your investment objectives that you have set accordingly. Well, that's it from me. I'll hand over to Peter now down in Australia.